Hi, my name is George Dagnino. I'm the editor of the Peter Dag Portfolio. There have been many economists that for the last 2 years they've been predicting a recession. Recession is going to come. It's coming, but it never came. As you know, we've been saying, look, as long as income and spending is growing, there is no chances of a recession. However, now things are changing, and we should notice that because has definitely an impact on the investment strategy. As you know, this is our reference graph, and this is the business cycles. As I mentioned in previous videos and my publication, we are roughly in phase four. The trick is to find out when is phase four ending, because in phase one, this is when growth, markets, and everything start picking up. Why does phase four is so crucial to understand? Because this is when consumers retrench. Inflation is too high, home prices are too high, mortgage rates are too high. Consumers are cutting spending, and they will cut spending and reduce spending as long as until all those things that will look too expensive are become again affordable again. On the other hand, there is business who sees the consumers slowing down sales, they start laying off people, unemployment increases. Of course, they're cutting costs, so earnings start because of slower sales, margins get squeezed, profits decline, the stock market declines. So the phase four happens not because of the Fed or any strange other things. It's just because of a business reaction and consumers reaction, and they are trying to find a common ground. Only when things come down and things are affordable again, then what happens? Consumers will start buying again here, and then the business start all over again. I think we have been slowing down, but however, as I mentioned, there are some cracks that I think you should be aware of. And let me review for you. This is the Purchasing Managers Index as published by ISM and is for manufacturing. Manufacturing is 10% of the economy, employs, I think, around 18 million people. So as workers, so it's an important sector. It has been in recession, as you can see here, is below the crucial 50 level, has been in recession for 2 or 3 years. Manufacturing is in real trouble, and this is what really have been dragging down the economy to a slower growth of around 1.5%, 1 to 1.5%, possibly 2. Construction is a very important sector because it's one of the first one to go in a slowdown or a contraction because of rising interest rates, because of the amount of money needed to implement construction projects, is one of the first one to uh, show strains. In fact, as you can see in previous recession here and here and here, every time there is a recession, employment in total construction spending, total construction spending declines ahead of a recession. The fact that construction spending has been declining, this is, as you see, is a leading indicator of recession. So this is the first important crack in the expansion. Construction, an important sector, roughly 20% of the economy, is in trouble. Employment overall is also in trouble, as you can see from the quits and job openings have been declining since 2022. It is a leading indicator of the economy, as shown here in 2007, 2008 recession, and as shown also in this phase. So the decline in job openings is a sign, the continued declining job openings is a sign that employment is weakening. This chart shows the growth of total non-farm employment, okay, and has been slowing down for a few years here. But what is the importance of this chart is that when the employment slows year over year, the growth declines to below 1% around this level here. What you can see is always a recession. Here, you can see it here, you can see it over here, you can see it here, again here, here, here. So in every recession of the past 60 plus years, since 1960, every time employment has slowed down to below 1%, the slowdown is meaningful enough to signal a recession or a period of contraction in the economy. So this is a serious, serious sign that you should keep in mind. This graph shows the income excluding transfer payments. Transfer payments are income that you get from the government, Social Security, Medicare, whatever. So really, this is the income that you earn, people earn when they work, when they provide a service, or when they work somewhere. And what you see here is exactly the same as manufacturing. When income, excluding transfer payment, reaches this level here, which is now, this is after inflation, by the way. As you can see here, here, at this level, here in the 60s, here in the 50s, in the 50s, in the 50s, there is a recession. So income has slowed down quite significantly because, of course, business is slowing down and they're cutting salary, cutting employment. Employment is not growing as fast as it was before. So this is another important crack in the business cycle. You have employment and you have income. These are two and you have manufacturing. So these are three important sectors of the economy that show really some problems, and you should be aware of it. But not everything is negative. This is why events in the economy take place very, very slowly, and you have to stay on top of it to really recognize this very small, minuscule changes. Yes, income and employment, manufacturing are weak. However, personal consumption of durable goods, which is a big ticket items, is still growing at a nice pace. This is consumption of big ticket items. So the people, consumers, are still buying refrigerators, are still buying cars, as being buying big things. So this is a positive thing that is holding up the economy, and that's why it's so difficult to see if it's going to a recession or not. The transition is very, very slow. And these are our business cycle indicators. They, as just to remind you, this is when the economy is strengthened. These are derived, by the way, derived from market data. They are not economic data. This is what the market is saying. The economy is strong by cyclicals. The economy is weakening by defensive. The economy is strong by growth, cyclicals. The economy slows down and by defensive stocks. And I showed you in my publication that this has been exactly what has been happening in this cycle. Now, where the business cycle indicators are saying is we are in phase 4, phase 1, somewhere in between there. So this could be a great buy point in the market cycle. But again, we need to have the conditions that create the bull market, that create the next strong economic expansion. So this could be going up, it could come down, like, go up and down for a year and then finally shoot. So this could probably decline a little bit, hover around these levels, and then picking up again. So the economy was expanding, everything was rising up to a couple of 2 or 3 months ago, but now there are some cracks. Why? Where? Well, first of all, the most important one is construction. The big money that the government has allocated to infrastructure is really slowing down. That's what really the weakness comes from. But the construction is declining, employment in construction is declining, job openings are declining, quits are also declining, which is an important sign of weakness in the employment picture. Manufacturing has been in contraction for 2 or 3 years. The good news is that, well, the income and spending is still growing at around possibly 1.5%. However, if you take income, real income, excluding transfer payments, has reached levels that have been associated in the past. The growth rate has been associated in the past with recession, the same as employment. Employment has slowed down to levels that in the past said we are in a recession. The business cycle indicators here are saying be aware, don't panic, because there's going to be some weakness, but this is going to present itself as a solid buy opportunity. So again, when you are in phase 4 moving into phase 1, you have to be very careful not to be too pessimistic, because there could be a turning point again and the market could take off and leave you behind. As you know, I've been pretty optimistic in the past several years, couple of years, and I was showing the economy growing around anywhere between 1.5% and 2%, with income, employment, everything growing at a nice pace. The purpose of this video was to tell you to be careful, because now there are some cracks happening in the data, in employment, manufacturing, income, and these are important signs that investors should be aware. However, like in everything, a period of slowdown in the economy or contraction, it could become an important buy opportunity. And we will, in the next videos, we will show you which indicators, market indicators we are watching to give us the sign to go ahead and buy. Thank you very much for following this video. I sincerely hope you found it useful. Please leave your comments, what you like, what would like me to investigate a little more in detail so that it can be more useful to you. Again, thank you very much for being here, and I hope to see you really, really soon. So long, and have a wonderful day.